So there's not much more to it. And of course, you could expand this to a couple more assets. Now, another one that's kind of interesting, that's also quite uncorrelated, is, for example, long-dated bonds. And one of the long-dated bonds is called TLT. I'm actually just really interested to see what this does. So, whilst we're at it, TLT has a really low Sharpe ratio, 0.15. So that's not particularly interesting. And let's just see what curve that gives us. Well, it's maybe not as good as we wanted it to be. So let's see if we can do the optimization on this as well. Now, what we have to do is we have to introduce here another constraint, otherwise it won't work. And actually, these 0.5s, that was a bit wrong. We shouldn't have started with that. And now we actually want 0.25 because we've got 4. Before we had like 1/3 each. But actually, you can see it doesn't actually really matter too much. If you're not too far off, the optimizer will force it to be correct. So let's run this. And there we go. Here we've got, interestingly, look, it weights TLT surprisingly large. And we've got this. And now here comes, oh, wow, look at this. Another 0.5 just by optimizing it. So that's pretty cool. So we're actually improved. Now, we could go on with this forever, but in reality, normally, it's not exactly right to do this. What do you think is the issue here?
I think it's over-optimization.
In some ways it is. And the question is, why is it over-optimization?
Because there are certain stocks or assets that are kind of correlated to each other, but that's not always for sure. Like, for example, with crude oil or something, there's always something that can happen that's completely cracks it.
Yeah. That's not actually really the reason. I mean, with the correlation, let's have a look, because we can just check how correlated these actually are. And you can see here the correlation is generally pretty low. Look at this, 15, 13%. This one's 28%. This is minus 18%. And then here 2%. So they're actually pretty low correlations with each other. That's really good. So we can really see when we do this, all the alphas will add up. But the problem is we optimize this on the whole data set. So when we basically optimize on the whole data set, we don't know whether this will still work going forward into the future. Yeah. Mm-hmm. And so one thing we can do is we can actually optimize the weights on a smaller data set and then see whether this still gives us a good Sharpe ratio over the whole period. Mm-hmm. Yeah. So all we need to do is effectively, we just, let's say, chop off 1,000 days of our set here. Yeah. So we actually see this. All we need to do, we calculate the Sharpe ratio now on a slightly reduced data set. And then we look at the last 1,000 days and if they still hold up. Yeah. Pretty simple. So this is what you call in sample, out of sample. And you can see it's actually interesting here. TLT is now far higher weighted. And let's just see what the overall Sharpe ratio is. Wow, it's even higher. Mm-hmm. Well, the main reason for this is because we optimized the earlier part. But if we actually look at the last 1,000 values, it may not be that great. But we could actually check. So what do we need to do? So we got rest.fun. Yeah. Now, what we can do is we can actually, we cannot use our objective function because we have the 1,000 less. So what we want to do is we want to, let's just do this and put it here. But instead of the last 1,000, we actually want it from 1,000 to the end. Yeah. And then we just print S and see what we get. So the Sharpe ratio in our out of sample is 0.6. Yeah. Now, it's not too bad. The question is, what was it before? So if we didn't do this, so if we just comment this out and we run it again, Wow, look at this. We actually improved our Sharpe ratio by in and out of sample. So that's a pretty good result. And, sometimes that's just pure luck. So by actually not taking the last 1,000, and 1,000 values is about 4 years, because we've got 250 trading days. So we've got about 4 years that we left out. And by doing that, we're actually not really making our Sharpe ratio much, much worse, which is pretty good. So this is effectively how you test these things or how you do it. The Sharpe ratio isn't obviously constant across time, so it sometimes is a bit better, a bit worse, and especially recently we've had some quite significant turmoil in the market. So you would expect the Sharpe ratio overall being a little bit lower.